Well, expect to achieve 17 to 18% EBITDA margins over the next 2 to 3 years. That's the word that's coming in from Tarun Arora, CEO and whole-time director of Zydus Wellness, on the sidelines of the Motilal Oswal India Ideation Conference 2024. Mangalam spoke to him on consumption trends, the categories they expect to perform well going forward. Let's hear out what he had to say.
When I look at Zydus Wellness, it's a very unique company because it's FMCG brands, but it is built around brands which are science-based, which are good for you. And we have two parts of our portfolio. One is the food and nutrition, and the other is a personal care. Yes, you're right. Over the last few years, if we look at it, the growth looks a little underwhelming given the expectations that we had. But it's still ahead of the industry. And actually, if we include 2019 post-acquisition of Kraft Heinz, which is what the benchmarks mostly look at, we had a great year. And then 2020, a lot of categories sunk. For example, Glucon-D had, glucose powder had 30% degrowth in the category, and the consumers went away. So I would say a good way to look at us would be last 3 years growth post-COVID, when things have settled down. And our growths have kind of got better and more consistent over that period of time. And we do believe we are well entrenched or well prepared for building a double-digit growth across our portfolio. One of the important things or unique things about us is that in our portfolio, with the exception of only one brand, most of the brands are category creators, they're market leaders, they actually build the whole category. So the task of growing the categories is what lies on us, especially in our core of our product portfolio. And therefore, what will drive our category growths going ahead will be largely focused on recruiting new consumers. So penetration is a single most key driver for us. Of course, we'll drive consumption. We are also looking at adjacencies. We're adding more products. But most of our products, being market leaders, are not focused on only just a market share gain, but focusing on growing those categories.
Right. So let's talk about those.
If you really look at us last 3 quarters, yeah, sure.
Right. So let's talk about some of those growth drivers itself. You said that you have been category creators, and the key driver would be penetration. If you could give us a sense of what your overall distribution reach right now is, where do you intend to take this over the next couple of years, and how would you define an increase in penetration? What do those levels stand at across your categories right now, and what your target is?
Yeah, I think, so if we really look at it, when we acquired Kraft Heinz about 3 to 4 years back, when we looked at our availability across our portfolio, as reported by Nielsen, was only 1.8 million outlets. Today, that's already gone to about 3 million outlets. For us, it'll be great to get to 4 million outlets as in next couple of years, next 3 years, we should cross 4 million outlets in terms of just availability. Also, we've been pushing fairly hard to reach out to new age consumers, and therefore our organized channel, which is mounted in e-commerce, stands at 22% kind of numbers as a portfolio, where e-commerce has really been at a cutting edge. We are at 10-11% of our business coming. Some of our products like Complan, Everyuth do even more than that. So we've been pushing that number pretty hard in terms of getting new age consumers, building the reach. From a penetration point of view, if we look at it, we have seen almost 20 to 25, sometimes 30% growth in penetration levels across our portfolio, especially for brands like Glucon-D and Nycil. And almost 2/3 of that growth, for example, in glucose powder, has come from Glucon-D in the whole segment that we play. Similarly, in prickly heat and cooling, the functional talc space, we've been more than 40-45% of the growth of penetration has come through Nycil, and coming not just from new consumers but also from people using other kinds of talc. So similarly on Everyuth, when I look at scrubs, now that category was almost about 7-8 years back 130-140 crores. It's become 310 crores. With our market shares moving from a 30% to a 46%. So recruiting new consumers, growing these categories, and clearly enhancing market shares, because these new consumers come at a disproportionate level to our business. And that's really been fundamental of us.
All right. Final couple of questions before we let you go. One is on the acquisition that you made of RiteBite. It does about 120 crores
Sure.
in annual revenue. What is the total addressable market here, and what is your plan here? What's your target? Are you looking at 500 crores in the next 3 years? What are the milestones here?
So the addressable market may be about 300 to 400 crores as it stands, but it is growing. There is a reasonable amount of tailwind because consumers are seeking nutrition through this new age products like bars, protein chips, protein cookies. We could grow this market itself, which could be a much larger space because really speaking, if it starts getting into adjacencies, it starts picking up market from the base categories like, for example, chips and other spaces, it could get much bigger. Last 3 to 5 years before the acquisition, we've seen a good 25% growth. We do believe that going forward, we have every reason to build on it as we move forward. So that is the kind of trajectory we believe we'll take forward and grow it bigger from that. So
All of this,
we are quite excited about what we can do with it. It fits in very well.
All of this brings us to a two-part question.
Sorry?
One is on your margins, and the other one is on your ad spends, because you will have to spend on increasing your distribution, increasing your reach, etc., and obviously marketing, putting money behind those brands. So what are the margins that you're targeting in the very near term, and what are your ad spends likely to be going forward?
So fortunately, we have a reasonable fix on how we want to build it. Our EBITDA margins came under a little bit of pressure during when the inflation was running high. In last 6 quarters, we've been able to expand our gross margins and EBITDA margins. Some part of it we have invested back in the marketing. We believe going forward in next 2 to 3 years, we should get to a 17-18% EBITDA margins. Investing on growth for distribution, etc., is something already baked in. We want to retain a 13-14% level of investments on advertising and other marketing activities. I think that should be sufficient money for us to, build on our portfolio growth that we're looking at in double digits going forward.
Final question, double-digit growth implies what? Mid-teens, low teens, high double-digit, high teens, above 20s? I'm just trying to understand.
Yeah, double digit is means a lot, but we're looking at teens given the earlier given the way the market is, and I won't be able to give you any specific number around it, but I think that's the best I could let
First
you,
half of this year,
give it to you at this stage. And
first half of this year, you
Sorry?
did about 15%. Do you think that is a number which is sustainable?
correct. I hope it is. The market is much harder, but we're working trying to get to that over a longer period of time.
Interesting conversation.